Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our March 2026 update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. Well, what a March it was. A mega whipsaw month if there ever was one. So no long introduction for this edition. Let's get right to the update, Andrew. Over to you.
Thanks, Mike. Well, after firing on all cylinders in January and February, we gave back about a third of year-to-date gains in March. Basically, long gold and long non-US stocks, both ETH and emerging markets, drove big gains in the first 2 months of the year for CTAs and many macro investors. But the Iran war upended both those trades. All three trades reversed a rather stunning 8 to 12% in just a few weeks. And as we'll show you in several slides, we gave back most of our gains on those positions. So we're calling this the Great 2026 Macro Do-Over. Fortunately, as you'll see in the second bullet point, we pivoted into a long crude oil position earlier this year, which generated large gains as crude spiked 70%. And as we point out in the second bullet point, this is what we mean by early, contrarian, and right. CTAs generate most alpha from a handful of key trades, which is precisely what we seek to replicate efficiently. Now, turning to performance in the left column, you can see that we finished the quarter up nearly 8%, slightly ahead of the SGCTA index and somewhat farther ahead of the Morningstar systematic trend category. But if you turn to the right, you'll note that we essentially gave back year-to-date outperformance in March. Now, on this point, I have noted when the complexity of CTA hedge funds and mutual funds, many more instances, more elaborate risk controls, have backfired. In fairness, though, last month was a very good example when those features did reduce downside risk during very, very sharp inflection points across the macro landscape. Still, from a replication perspective, I'm pleased to see that we're still outperforming despite the severity of the market whipsaw last month. Now, here's our performance since launch of DBMF in 2019. So now over more than 6.5 years, we've added more than 355 basis points of returns per annum relative to the SocGen CTA index. Outperformance relative to Morningstar category is even higher. The live strategy track record dates back to July 2016 and also shows similar outperformance. So to repeat what I said last month and the month before, what we believe the data shows is that commodity trading advisors, or more commonly known as CTAs, generate a very valuable signal. Sometimes this idea of being early and contrarian about big shifts in the macro landscape, but that high implementation costs do significantly erode performance. So in virtually every statistical measure, investors would have been better off replicating hedge funds over the past decade rather than investing in hedge funds or, for that matter, mutual funds. Now here's our slide on volatility-adjusted positioning. The green bars are the volatility-adjusted exposure of our 10 futures contracts at the end of March, and the red dots are positioning at the end of December. Now this is a pretty good picture of just how dynamic the portfolio can be during these kinds of extreme market moves. Moving from left to right, we started the year with no crude oil exposure, started adding in January, and by the end of March, we were very close to max long positioning. Clearly, we like this positioning if the situation in Iran leads to further spikes in the price of oil. We maintained our gold long, but in the face of the March reversal, dialed it back somewhat. We continue to be a long spread trade between the euro and the yen, but less so than several months ago. We've shifted from a yield curve steepener to a more bearish view on treasuries across the curve, which might be helpful in a resurgence of inflation. And lastly, we've meaningfully cut net long exposure to equities, but we have maintained exposure to outperformance of non-US equities, what I think might be a multi-year rotation as the risk premium on investing in the US clearly has risen. Now, we should expect positioning to continue to adjust, quite dynamically as markets hunt for direction. And finally, here's year-to-date contribution to performance. Well, this sort of says it all. As noted, we gave back gains in gold and most of the gains in equities, but have now made over 700 basis points this year on crude oil. Currencies and rates have both been choppy. Now, while I prefer to see the gains more evenly distributed, in the best periods like 2022 or last year, we tend to see gains in, three of the four asset classes. But honestly, I'll take it given the magnitude of the market moves in recent weeks. And with that, back to you, Mike.
Great. Thanks, Andrew. So let's wrap up here as we always do with long-term performance numbers for DBMF. Annualized returns since inception, including the month that was March 2026, dipped a bit, but is still 9.16%. And that's ahead of the SocGen CTA index by over 355 basis points annualized and it's ahead of the Morningstar Systematic Trend category average by over 480 basis points. And long-term outperformance against the traditional diversifier for equities, that being bonds as represented by the Bloomberg Ag, remains well intact, DBMF outperforming by over 760 basis points annualized. So thanks everyone for checking out our monthly videos. If you have any suggestions in terms of things you'd like to see added, changes, feedback, or inputs, please let us know. Otherwise, if you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgp.com.